IT space, this segment of the market has done fairly well in the last couple of weeks. We have now with us Sandip Agarwal joining in. He's fund manager at Sowilo Investment Managers to give us a sense in the outlook for 2025. Sandip, great to have you on the show. I was just going through the highlights of a Citi note that has come out specifically on Infosys, and Citi feels that Infosys is finding some green shoots now, and discretionary spends are picking up in the BFSI space, particularly in the US market. But you tell us, what's the overall trajectory? There's a lot moving with the Trump presidency, but purely in terms of demand, how will next year be for some of these larger firms?
Yeah, hi, good morning, and thanks for having me on the show. So, the way I look at it, obviously, with Trump coming in, and if the economy in the US picks up momentum, any which ways, that, today for growth, you need technology infrastructure and spend on technology because most of the things have moved towards digital. So obviously there will be a big delta there, and many people who have been holding back on discretionary spend because of the impending US elections earlier, they may, open up now more. The only thing which I believe needs to be taken care of on the cautiousness side is that remember that Trump is coming and he knows who is making how much money and all that. So there could also be some kind of cost which can come for doing business there. So although there is no alternative to Indian IT because we hold almost 96% of the pure IT services market, which is outsourced if you exclude the BPO part. So we have definite monopoly and the scale and everything, but still you never know, politicians can, do some arm twisting. So right now we are only seeing the positive part of it, but there should also be some cautiousness on if the cost can go up for execution.
So what's, after this 26-27% kind of a year-to-date rally for IT stock, what's the broad call? Do you think 2025 will hold moderate returns? For the sector per se, and if you had to pick one stock where the growth is the highest and the risk reward is reasonable, which one would it be?
So I think, and we have done this interaction several times in the past. Last year was the time when there was maximum pessimism, when offered letters were withdrawn, variable pay were postponed. I think that was the bottom, and we have said that whenever this has happened, and this keeps happening every 3-4 years. Funny part is that whenever offer letters get withdrawn or variable pays get postponed, that is the bottom of the industry because corporates only go by data. And when these things are happening, that means data is at the bottom. So that is the time when stock should have been bought, and we have seen almost 40% run up from there. In my view, now the returns will be commensurate with the surprise in the earnings growth and not with what it is there. So I think the surprise in earnings growth, 2-3% revenue growth surprise and 5-6% earnings growth surprise is what is left, and some re-rating. So I would agree that there is moderate return going forward, although the numbers will surprise positively a little bit on revenue growth and more on the margins. But because multiples have already re-rated, you will not get any delta on the multiple side from me. On stock, we run a PMS and we hold few of the tech names in our portfolio. So very hard to comment, but I would say that the inexpensive large caps would be the ones which you should have a look. I think telecom has not done well for quite some time. So company with higher telecom exposure, product engineering exposure, those are the ones which will do well. Also in the mid and small cap, although the multiples may look very expensive for ER&D, I think ER&D can open up in a very big way. Remember 3-4 years since Ukraine crisis happened, the ER&D space has not done to its potential. So there could be a big delta there in the ER&D space. So although some stocks are expensive in that space, but that space can open up in a big way.
All right, and the two ER&D players would be KPIT as well as Tata Elxsi. Both of them have come up from the top. So between the two, what is the preference?
Again, hard to comment on preference, but I would say that any ER&D company should do well for next 2-3 years, because if you see the data last almost 1 year, ER&D companies have been struggling a bit, and for no reason, because demand is very strong. There are some Ukraine war related issues, some visa related issues because of which this is happening. I think 10 years there is a structural bull run in the ER&D space. So the multiples may look expensive, but for a long-term investor of 3 to 5 years, you will make phenomenal return in any of the good ER&D companies where quality of management is good.
Okay, so ER&D is looking good, but just to round it up, Sandip, what you're saying is that from an investor perspective, that play has already happened, ER&D, with the stock price appreciation, right? So you're saying you would rather look at large cap IT at this point?
So I'm saying in IT services, I will look at large cap IT services with exposure towards sectors which have not done well, like telecom and product engineering. And in the mid cap, I will look at ER&D plays where even multiples are higher and they have run up, but there is a long delta there for next 3 to 5 years at least. So in ER&D, I will play even expensive stocks, but in IT services, I will play large cap, which are reasonably priced and exposure to telecom and product engineering.
Okay, got that. So ER&D, you're willing to pay more because you see that growth runway ahead. Got it. Thank you very much for joining in, Sandip. Always good to have that perspective. Great to have you on this morning.